Live.
Hi everyone, thank you for tuning in for the last session. So on this session, we have Max Tan, the founder of Want to Invest, here with us to share about value investing in Malaysian stock market. So in this session, Max is going to share brief update on the existing market and discuss on cyclical stocks such as plantation, oil and gas, steel, and tech stock. So before we start our session, a little bit of background introduction for Max. So Max has been investing in Malaysian equities for more than 5 years, so focusing mostly on Malaysian equities only. So he has started his personal sharing on Facebook under the page of Want to Invest since 2018. Since then, his investment journey accelerated as well the platform. So for the past 2 years, he has been fortunate enough to be invited to share his personal experience in many occasions. So without further ado, let us welcome Max.
Hi, morning. Should be afternoon by now. Thank you for the introduction, and also good afternoon, everyone. Welcome to today's webinar on investing note. Now, today I would mainly touch about the topic of viability of value investing in Malaysia stock markets. Of course, half an hour I couldn't cover too much, but I'll quickly go through what I'm going to share today, and then we will try to jump into the Q&A session if possible. Now, before that, please allow me to do a quick introduction about myself again. As you know, I'm a financial blogger on Want to Invest. So our platform mainly focus on sharing stock market investment information. We focus on value investing team, as I myself is a value investor. So far I have been investing for like 5-6 years by now. I tried numerous ways of investing or trading. I started off with trading, but ultimately that didn't work out with me. So I ended up with value investing I think it suits me the most. So when we come to talk about value investing, a lot of investors, they would think about investing in stocks. When we talk about value investing, they would think of stocks like, oh, Maybank, Powerbank, Genting, Nestle, Hapsing, Padini maybe. And maybe some of the investors with experience, they would think of Magni, Lihan, and some of the good low PE, high dividend yield company. Now, this company, no doubt, they are very good candidate in terms of both attractive valuation and also dividend. But today, I would like to further expand the topic into extracting value from listed companies. Now, some companies, they might appear to be making losses at the first glance, might seem to have no value at all. But personally, I think that this kind of company, when they are turning around in terms of their financials, the profit they were brought to investors is very substantial. Okay, but again, this kind of value investing, it requires a lot of qualitative analysis than the quantitative analysis. Again, this is just my personal opinion. So without further ado, we shall jump into the value investing topic in Malaysia stock market. Just a quick disclaimer. Today's session is purely with the objective of sharing my personal experience and knowledge. It should not be served as any buy or sell call, just in case we mention any stocks name. Okay, now let me do a very quick update on the current market. I know that everyone has been very worried about the COVID-19 confirmed cases. Malaysia had breached the 20,000 mark in the past week. I think it was on Thursday, and it is expected to rise even higher based on the information I get from my friend in the medical sector. So apart from it, there might be some aggressive testing work, again, from my friend in Penang, who is in the semicon industry. There might be some aggressive testing moving forward in the Penang area, despite they are already in the phase 2 of the National Recovery Plan. So we might see more confirmed cases coming out in the Penang area, which might or might not impact the sentiment about the tech sector. Okay. Now, as investors, sometimes we might get scared off from the high number of COVID-19. We might be worrying that it might stun the economical activities. But in reality, there are some sectors that are able to operate at a 60% capacity. So the impact, it's not as big as we thought sometimes. I think it is also important to look at the other spectrum where our country had over 500,000 vaccination count. More than 500,000, in fact, in a single day. To date, I think our vaccination coverage is around 24.4% to 25%. I'm not sure about the latest one, but at least we are 24.4% so far, which I think is really impressive. And logically speaking, I think, again, personal opinion, that our country is not that far away from a further easing of economy activities. Now, I also understand that there had been a lot of political, issue going on, which again it might impact the gradual reopening of the economic sector, because policy can change whenever they have this so-called political issue going on. But if you look back into 2021 alone, there had been more than 5 times of this kind of political changes, so-called political changes, which I had already got so tired of it. And if you are doing value investing, your investment horizon is slightly longer. Typically, I think you should ignore the noise, and then you focus on the recovery of the whole nation. Okay. Again, at the same time, I think there are a few more factors sectors that we can look into, especially the cyclical sector. They actually have been beaten down quite badly. This is despite the high running commodity prices. For example, steel company, they are performing so well in China before the setback. They are performing so well in China. Some of them actually, most of the company, they hit limit up in China. And then also in US, the steel company performed quite well as well. So I think that when you reflect to Malaysia, steel prices are moving high, but the company share price have not moved at all. So I think there might be value to be identified in these kind of companies. But here comes the question: how do we define value? To me, value is the true worth of a company, and it can come from several aspects. For example, the easiest way to gauge the company is by earnings, the typical PE ratio. But cash flow on some company that have a lot of depreciation, which is non-cash flow in nature, it just impact your P&L, but in fact, your cash flow is okay. So this kind of company, we should look into their cash flow for a better reflection in terms of value. We might not have the time to dive into revenue recognition and also delay receiving cash due to the trade receivable and also business model. But maybe if we have time at the end of the session, we will try to take some case studies. Okay. Besides some assets, spin-off is also another aspect that we can go for valuation. For example, privatization. I'm sure that MMC Corp is a very good example of capital reduction. But today we are going to mainly focus on the earnings. For some reason, Malaysian investors, I noticed that they don't really like the cyclical stocks. Probably is due to the hard to predict in the bottom line, which is the profit after tax. Let's take the steel company we just mentioned as an example. So far, if you notice, the steel prices has been increasing rapidly due to, since last year, the supply squeeze. Now, logically, large US infrastructure spending would ultimately result in a higher demand in steel, and it would drive the prices. Again, China, the largest producer for steel, they have imposed some restriction in steel exportation in order to fulfill their domestic demand, and also as an act to cool off the price, of course. Again, this might cause the increase of the steel price as well. So in Malaysia, we have a couple of steel midstream and also downstream player. Based on some feedbacks I got from the listed construction companies in Malaysia, the steel players, they seem to be able to pass on the cost quite effectively, because construction player, they can't really nego on the steel prices, especially subcontractor, which is quite bad. But when steel company, they sell to distributor or they sell to end user like manufacturers or construction players, they are able to pass on the cost increase. Okay. Now, if you look back into Q1, which I think Q2 is coming out really soon, it's August already. Sorry. Okay. Sorry, back to where am I? Q2 is coming up. If you refer to Q1, we would notice that a lot of these steel companies, they are able to make good profit. But it's just some of the companies making good profit. It's not all of them. For example, Lion Industry, the company, okay, in terms of steel, they're doing okay, but they have been impacted quite badly due to their consolidation of Parkson, the retail company. Parkson has been making losses. It consolidates into the company's bottom line. So it actually impacts the Lion Industry as a whole. But for other steel companies, for example, like Helptech, they actually perform still very well. So why is the share price not going up if they are performing so well? After the MCO 3.0, unfortunately, steel operators they can only operate at the 10% capacity. To be honest, 10% capacity, I don't think it will be sufficient to even cover their fixed costs. In June, July, now August, we are on 7th. There had not been any clear instruction of reopening on the steel operators. So you can expect that these months, if you take April, May, and June, Q2, we can expect June actually brought some losses into Q2 as a whole. And then July, August, it brought into Q3. Depending on how quick our government reopen, I think these months are going to be not so well for these companies in short term. However, I think that after the easing of the economical lockdown, as our local construction activities recover, as you know now, only a few selected projects are able to operate in terms of construction activities. Most of them are in the infrastructure sector. So in terms of residential building, for example, house we are staying in, unless they have a hostel for their worker, they are not able to really go on with construction activities. So again, when reopening, the construction activities, they will recover and continue. Then the steel demand, they will be back. So the earnings will reflect, definitely not in Q3, in my opinion, but in Q4, the activities recover, the steel companies should start to make very good profit due to the higher selling prices. If you normalize some of these steel companies' profit, sometimes you might even arrive at a very low single-digit forward PE ratio, probably less than 8 or some even less than 5 times. Now, we know that stock market forever, they will reflect quicker than the actual economical activities. So before Q4 arrives, I think that steel companies, they have a value to be found when the economy recovers. So same for plantation companies, especially on palm oil related companies. I love palm oil related companies. You know that CPO prices, they actually reached to historical high level, but although I don't think that it was sustainable, but as a rule of thumb of investing into some of the palm oil companies in Malaysia, when CPO prices are above 3,000 per metric ton, I'm talking about market rate, okay, most likely this kind of company, they can achieve quite good results, okay? Now, palm oil business, it might be slightly more complex as you have to go into yield per mature hectare. You have to find out the extraction rate for palm kernel and also CPO. You also have to know the age of planted trees. For example, if not mistaken, they start to producing after the age of 3, and then they can produce for another 20 years. Okay, they also have their prime production and also the time frame where they slow down the production. Another critical issue that plantation company is facing is the labor issue and also weather issue, which is, I think it ended on April or May, the El Nino effect, which has impacted the production. But I think for new investors into the plantation sector, for simplicity's sake, I think you can refer to plantation companies. They're delivering quite decent profits even during CPO prices are low. So you know that even, okay, let's say during CPO prices are 2,000 per metric ton, they're still able to deliver quite decent profit. So imagine what will happen when it goes up to 3,000 metric ton. I know people are worried about the windfall tax, but in reality, you have to earn that much of money in order to be charged the windfall tax. So ultimately, I think the earnings will definitely outgrow the windfall tax. Okay. There's also something that I think a lot of investors, they miss out by using the Bursa announcement, or you can also refer to Darren's platform, Investing Node. Maybe you can check on some announcement of companies. They actually announce to you per month production of their, some company, they only announce the fruit of the crude oil, the palm oil, the FFB, fresh fruit branch, or they also announce, some of them also announce extracted palm kernel, PK, and also CPO on a per month basis. These data, they are publicly available on the Bursa announcement, or alternatively, you can also go to some paid platform, which I don't think is really necessary, since you can find and compile it from the Bursa Malaysia website or Investing Node. Okay, so back to the plantation side again, if you refer to the plantation company's share price with the current CPO prices, I think that seems to be a bit of a valuation disparity. Now, I understand that plantation, they might not be able to convert their profits into high growth expansion like manufacturing companies. They cannot just say, okay, this year I earn 100 million. I'm going to set up another palm oil manufacturing plant which could manufacture more palm oil. No, plantation takes time. They couldn't translate into value immediately, but some of these plantation company, they could create value for investor from dividend payment. I personally love plantation with good dividend payment, especially with good profits coming up. Okay, I expect in this month, again, a lot of plantation, they will announce their quarterly result, and based on the production they had announced in the past 3 months, past 3 months, April, May, and June, I think that generally their results will be quite good. Okay. Of course, the oil and gas sector, the typical cyclical sector that investors know of, it's even more complex because it has the upstream, midstream, downstream. Then when oil price increase, then it had a different impact on the share price altogether. But if you take the increase in oil price, let's say Malaysia generally, we refer to the Brent oil price. You take upstream oil producer or upstream service provider like maybe Yinsen, okay, they lease FPSO and also they are engaged in the EPCIC segment. When oil price higher, you could expect they have higher profit margins contract for bidding. Okay, for example, EPCIC maintenance contract. It would be better for the upstream players as a whole when the oil price is up. But for companies that are involved in the downstream, for example, petroleum refined products like naphtha, the high oil price, if the naphtha in the market is not facing shortage, now it's facing shortage, so they could transfer the increase in oil price pretty well, because the market needs naphtha for the production of polymer, so-called plastic. Okay, so oil price, they might affect this refineries profit margin. Okay, that is not the case for now, but historically that has been the issue. Naphtha, the demand is so-called so-so in the market, but then oil price increases. Naphtha, normally they have a delay in transferring the oil price to the naphtha, so that some of the refinery, they actually got stuck, and then their profit, some will go into losses. Okay. So to be summarized, I think the key lesson to be found here is investors should look for the disparity between future earnings and the non-reflected yet share price, of course, especially due to macro factors. I started invested in the plantation and oil and gas sector for now. I think for the upcoming few months or earlier in 2022, when the so-called macro environment started to turn, I think the market might start to reflect. But again, this is my personal opinion. Market might or might not reflect. That's why I'm investing into, for example, plantation company with good dividends. Even though the share price might not reflect, perhaps you would skip our capital gain. But again, if you get dividend return, I think it's quite good as well. Okay. But most importantly, I have learned this lesson in a hard way, and I can't emphasize this enough. Please do not hold on forever on cyclical stocks. Even if you buy on a low cycle, the fluctuation on commodity prices will still impact the share price. So imagine this, you buy on a low cycle. So for example, on the next, let's say 2 years, okay, it's in a high cycle, you still don't need the money, you wouldn't sell it. Then another 2 years, back to the low cycle, you want to take profit, probably the cyclical stock has back to the level which you had investing, and some might even lower. That happens in steel company. I think if you look back into 2015 to 2018, it was quite bad. It was quite bad. So if you're investing into cyclical profit, when it's time that you think you should take profit, you may do so, of course. Value investing to me is not necessary like holding into long term. It ultimately depends on what kind of company you're investing into and how do you realize the value before the value is gone. Obviously, when the down cycle is there, people react first and then the share price will drop, so that it already reflected the future value of the company, in my opinion. Okay. I also promised to talk about the high growth technology sector, obviously semiconductor chip shortage, and also as you can see, US and China, they're rushing for their own self-sufficient chip. So what does that translate for Malaysia, especially on Penang side? Penang has a lot of back-end semiconductor player. They are involved in the mass production testing. They're involved on the vision inspection side. I'm sure you heard of them. Vitrox, Penta, these kind of companies. Personally, I also have quite a weightage in technology sector for now. But for those who have no position in technology, you want to chase after the share price, because I think you can see Kobe, Genetech, Sam Engineering, they had quite strong growth in terms of share price recently. Please be reminded that the current share price, to a certain extent, it's already reflected the investors' expectation of growth. Okay, if you look into semiconductor, these companies, they have around 60 to 70 times trailing PE. Trailing PE means that if you reflected the past 4 quarters PE, and then if you look into the forward PE by some analysts for next financial year, they're trading at around 30, maybe 30 to 40 times. The risk for you to buy into these technology companies is always on the expectation and delivery, unless you're holding for more than 3 years. Okay, you just think about it. The market is pricing a semiconductor company at 60 times trailing PE, and with 60 times trailing PE, people are expecting, if you talk about PE over growth, PEG valuation method, they are expecting the next quarter to grow on a 60% year on year. Okay, for a company that are able to deliver the 20 to 30% year on year consistently is very impressive. But imagine if they only deliver 20% year on year growth, what will happen to the share price? Definitely, that would be a setback in terms of the investors' expectation. Again, PE valuation, in my opinion, is something that could change day to day or even in minutes. Okay, when there's any negative outlook, the expectation is gone. So does the PE valuation, so-called rating on a company. So when a company is trading at 60 times trailing PE and deliver only 20% year-on-year growth, I don't think that it would be so good for the company in that sense. But of course, semiconductor, some of you may have already know, in the first half, some companies may actually face weaker order, and then it recovers strongly in the second half of the year. For example, D&O, it's a very good example. Okay, so I think investors must be very careful on this note. Again, value to a certain extent, I think it should be paged to your investment time horizon. Okay, if you're holding for a shorter period of time, do beware for higher valuation companies. I know that Inari, Vitrox, maybe even me, they had really good results coming up. Again, the expectation is there. So to conclude, I think there are a lot of values to be found in cyclical companies, and technology sector. I think people are factoring into the next 2 or 3 years growth already. Okay, if you look back to cyclical companies by comparison, it has been beaten down quite badly due to the macro factors, and also when the commodity prices are so high, but they are not reflected into these kinds of companies. So I hope that throughout the very short session, you would have another perspective to look at value investing, which is on the qualitative end. Sometimes it all comes down to your business sense in investment, rather than purely doing qualitative analysis. So remember, a lot of quantitative analysis, taking numbers, you're taking past data. When you're taking publicly available past data, for example, a very good result, it might be already reflected in your share price already. But qualitative, it's very hard to quantify it. It's very hard to define. It's very hard to value. Also, I think it takes, you have to look forward into the economical sector. I think comparable in the midterm, I think we have a better chance in some of the company that are beaten down quite badly, but the commodity prices are doing quite well. Okay, so maybe I jump into a short Q&A now. Let me check on some of the questions. Okay. Okay. Okay, one question, I think, let me look into it. Malaysia have very good fundamental companies. Unfortunately, I totally agree with you. I don't want to comment so much on a sensitive political issue, but if you think of it, it's not making sense. Some of the companies, you see technology companies are delivering so good results. And in the past quarter, if you look into the steel companies, as I mentioned, they are performing so well. But share price, again, is not moving. I did a quick study back into some of the cycle of steel counters, so-called they are spiked up over the way. The shortest spike in terms of share price or the industry as a whole is 2021. So I think there might be another chance for it to further move, moving higher. Okay, but again, it's my personal opinion. Which sector are you looking for the best in Malaysia? Definitely for now is the technology sector, as you know, why people are pouring money into it. Apart from growth, if you think of it, during the lockdown, the only one that can deliver consistent growth is the technology sector only. Solar energy sector, I think you might, there are different perspectives on the solar energy sector. There are EPCC player in the market. There are concession player. There are people that sign PPA, power purchase agreement with the government. For example, Renhill, they supply 32.5% of the energy to Sabah, if I'm not mistaken. So I think that EPCC, their margins are getting lower and lower. If you look at the LSS PV4, the tariff are actually very low. Okay, it's very, very low compared to SS1. So EPCC, they might see margin dropping. They have to take more contract to maintain a profit. Okay, can I take one more question? I think it's up to time already.
Yeah, I think can one more last question.
Okay, so sorry for the copper wire production. Maybe you can PM me. I can discuss with you. I think you're talking about Tawin maybe. That seems pretty interesting for the past few weeks. Do I think the momentum will continue? I think yes, the momentum will continue unless there are any negative news or any negative setback in the industry. But again, the setback will be quite bad due to the high valuation. People are already expecting 50%, 60% year-on-year growth. If you're outperforming, let's say you're delivering 80, 100% growth, okay, definitely no problem. The momentum, everything will go on. But if there's one or two company that have a setback, for example, like a DNO I mentioned, they might not deliver the growth as great as people think of. In terms of QOQ, I think year on year they still perform quite well because first half is typically a weaker cycle for them. So there might be some setback in terms of the prices. I don't know how the market will perceive it. In terms of risk to reward, I think that it's not so sexy compared to a few months back then, in my opinion. Yeah. Yep. I will be passing back to you guys.
All right. So thank you, Max. Thank you, Max, for the sharing. So ladies and gentlemen, this is the last session of the summit. And on behalf of Investing Note, we'd like to thank everyone for staying through until this session. Okay, so before we end, we'd like to invite those that have not signed up for the simulated trading challenge. You can still sign up. And the second week of the competition will start on coming Monday, 9 a.m. sharp. So there is a total worth of 30,000 ringgit cash and prizes up for you to grab. So if you have already signed up, so do remember to trade at least 3 transactions, okay, to be eligible for the lucky draw. All right, so lastly, we'd like to thank all the speakers today, Emilia, Jason, Luvi, Darren, and Max, for sharing your wisdom and all the wonderful knowledge. And thank you for the viewers for joining us today at Investing Note Trading Cup 2021 Investment Summit. So we wish you all the best. We'll see you again.